In September 2008, one of the oldest banks in America, Lehman Brothers, suddenly collapsed overnight. Literally overnight, $600 billion vanished. That's almost double the GDP of Ireland. People lost their homes, millions lost their jobs. And after the smoke cleared, just a few Wall Street giants stood tall. But what most people do not realize is it all started with a lie so simple it fit on a billboard. Why rent when you can own? But then who would buy these houses once everyone else did? And why were the biggest banks and investors so desperate to sell them? Let's take a trip back to 2002. We're in a housing market where prices are stagnating. So what does the Federal Reserve do? Well, they drop off another rate cut like it's no tomorrow. Overnight, mortgages went from around 7% to under 6%. And that may not sound like much, but if you save just an extra $1,000 a year on your mortgage, you could easily afford an extra 50 grand. So naturally, homeowners started refinancing and buying more houses. As a result, housing demand skyrocketed, lifting home prices by over 20% in just 5 years. But there was a problem. Not everybody could afford a house anymore. But fortunately, there was a solution. These companies now offer loans to anybody who wanted one, regardless of their income or assets. For example, in 2004, HSBC launched a loan called the 228 Pick Your Price Mortgage. You guessed it, 2 payments for 28 years. In fact, they even offered something called the no-doc loan, where you didn't even need to prove your income. Other banks followed suit with similar products like Citigroup's 100 Pick Your Payment Mortgage. With loans like these, home ownership became a right, not a privilege. Now, obviously, offering loans to people who can't pay them back is pretty risky. But that's where these lenders got really creative because here's the thing. Lending $100,000 was relatively safe, but lending $5 million was out of the question. But what if they could spread the risk around? What if they could sell pieces of that $5 million loan to hundreds of investors? Sounds like a good idea, right? Well, let's unpack it. They bundled these loans together and created something called mortgage-backed securities. Just imagine it like a giant basket holding hundreds or even thousands of individual loans. And then each investor could buy a little slice of that basket. But wait a second. These aren't high-quality loans. Many of these people will default. So how can you call it a security? Well, that's where things get really interesting because these mortgage-backed securities weren't labeled based on their quality. They were all labeled AAA. See, the higher the rating, the less risk the investment is. So if it's AAA, it must be safe, right? Wrong. These mortgage-backed securities were more like junk bonds than AAA investments. They were filled with subprime borrowers who were likely to default. But nobody noticed because these Wall Street banks were hiding the truth. Now, you might be wondering, why didn't investors just read the fine print? Well, to be fair, the fine print probably looked like this. However, there was a loophole. A way to make these risky investments look like a sure bet. And all it required was a little creativity. These credit default swaps worked like insurance. If the borrower defaulted, the seller had to pay up. But here's the kicker. These credit default swaps didn't require these Wall Street banks to actually hold any of the debt they were insuring. They just needed to convince investors that they could pay up. And believe me, they convinced them. By 2005, the value of credit default swaps exceeded $44 trillion. That's nearly 3 times the entire U.S. GDP. To put it simply, Wall Street found a way to make money out of thin air. They were creating trillions of dollars of value from nothing, so naturally everyone wanted a piece of the pie. Banks began leveraging up, borrowing money to buy more debt, which allowed them to buy even more debt, which made them even more money, leading to even more debt and even more money. Over time, this snowball effect created a massive financial bubble, but eventually that bubble burst. So let's go back to our story in 2008. The housing market had peaked, and prices began to fall. Suddenly, those fancy new mortgage-backed securities were looking a lot less secure. Investors started dumping them, hoping to cut their losses before the bubble burst. But they had a problem. Who would buy these bad investments? Well, maybe they could package them up and sell them to someone else. They bundled up these risky securities and sold them to unsuspecting investors. And just like that, they unloaded their toxic debt onto somebody else. But as soon as they dumped these mortgage-backed securities, the dominoes began to fall. Soon enough, Bear Stearns, one of the biggest investment banks in the world, couldn't find a buyer for its mortgage-backed securities. In fact, they couldn't find a buyer for anything. Nobody wanted their toxic debt, but that didn't mean they couldn't find a lender. They managed to convince the Fed to lend them $30 billion. In exchange, the Fed took an ownership stake in the company, and soon enough, they even bailed out Bear Stearns completely, saving the bank and punishing the shareholders. But while the bank survived, the same couldn't be said about its clients. All of their trades were now canceled. Clients who bought stocks on margin were forced to liquidate. Millions lost their jobs. And remember those billboard ads from earlier? Well, now people were literally paying to rent those houses instead of owning them. At this point, you might think things couldn't get worse, but they did. Just weeks later, Lehman Brothers, the oldest bank in America, filed for bankruptcy. Their CEO at the time described it as the death of a dream, and he wasn't exaggerating. The stock market plummeted. People rushed to withdraw their money from banks for fear that the whole system might collapse. But hey, at least the big banks were safe, right? Well, not exactly. They were some of the biggest buyers of Lehman Brothers' debt, and now that Lehman was gone, they had to write off all that debt, which meant they couldn't lend money or invest in anything. But fortunately, the government stepped in to help. Banks were given a blank checkbook, allowing them to borrow unlimited amounts of money from the Federal Reserve. So while these banks suffered, ordinary Americans were struggling too. Families lost their homes and credit markets froze up. Companies couldn't raise capital and the economy ground to a halt. At first, this economic crisis seemed to be temporary, but it quickly turned into something much bigger. Soon enough, countries like Iceland and Greece faced their own debt crises. Iceland's 3 largest banks collapsed and Greece needed a bailout. And then suddenly, the world was on the brink of depression. The only way to stop this downward spiral was to fix the banking industry. Banks were being punished for taking risks. They had every incentive to play it safe, to hold on to cash instead of lending it out. But without access to cash, the whole economy would grind to a halt. So the U.S. government passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. They established new rules and regulations for banks. They increased oversight, and they separated commercial and investment banking divisions. But the biggest change of all was the creation of the Financial Stability Oversight Council. This council keeps a close eye on the financial system and steps in whenever there's a threat to stability. But was it too late for some people? Well, let's talk about the aftermath. The bailouts were extremely controversial. On one hand, they saved millions of jobs and businesses. On the other hand, taxpayers were left footing the bill. And according to a report by the Government Accountability Office, at least $133 billion of taxpayer funds were used to compensate banks for losses on mortgage-backed securities. But despite the bailouts, many banks still struggled to stay afloat. Take Bank of America, for example. They received over $45 billion in bailout funds, but they ended up posting billions of dollars worth of losses on their books. In fact, their total losses amounted to over $80 billion. And don't forget the ripple effect on the economy. The GDP declined by nearly 5%, unemployment rose to over 10%, and consumer spending fell by over 7%. But thankfully, the worst of the crisis happened during the last quarter of 2008. As soon as the government passed the Recovery Act, the economy began to stabilize. Unemployment began to fall, and the GDP began to grow again. But according to the Congressional Budget Office, this crisis has reduced the level of GDP permanently by nearly 4%. Now here's the irony. Even though the financial crisis hit everyone hard, it wasn't all that bad for ordinary Americans. Sure, they lost their homes and their jobs, but compared to Wall Street, they came out relatively unscathed. But for Wall Street, it was a whole different story. Their reckless bets wiped out billions of dollars of wealth, and even though they were bailed out, They had to pay billions of dollars in fines and settlements. But they weren't done yet. They set their sights on the next big thing. They traded carbon credits, repackaged derivatives, and lent money to governments. And then it happened again. Credit Suisse collapsed, Silicon Valley Bank collapsed, and Silvergate collapsed. It seems like history is repeating itself. So what's the takeaway? Well, anger sparked Occupy Wall Street. It forced Congress to address income inequality and campaign spending. But today, it feels like nothing's changed. In fact, today, Wall Street is doing better than ever. But maybe that's the real story. After all, crises don't repeat, but they rhyme. Thank you for watching. If you enjoyed this video, please hit the like button and subscribe to support our work. As always, thanks for watching.